Hi everyone, this is Stephen with Dundas Life, and today we're going to talk about what is life insurance. Now, discussing life insurance may not be the most thrilling thing you'll ever do, but it's important to make sure that you and your loved ones are well protected in the case that something ever happens to you. Because after all, one thing's for certain, we're all going to meet our end at some point. So, to help you make an informed financial decision and see if life insurance should be a pillar in your financial plan, let's take a deep dive into the ins and outs of life insurance. Now, in essence, life insurance is a contract between you and the insurer. In exchange for your payments every month or year, the insurer agrees to pay an amount of money to your beneficiaries upon your death. Let's take a minute to define some of the terms that are often used when describing life insurance. We'll start with the different parties that are involved. The insurer is the insurance company which provides the insurance coverage. The person who receives this coverage is known as the insured. The insured can designate a beneficiary, and a beneficiary is an entity such as a person or organization. When the insured passes away, the beneficiary will receive a sum of money known as the death benefit, which can be put towards any reason they see fit. The policy length refers to the time within when the policy goes into effect and when the policy ends. In exchange for the coverage, the insured must pay an amount of money known as the premium to the insurer. Now, how expensive are these premiums? Well, the cost of life insurance depends on a variety of factors, including the age and health of the insured, as well as the policy length, death benefit, and policy type. So while some of these factors are out of your control, purchasing life insurance at a young age helps to keep premiums low. Insurance companies will also look at lifestyle factors, such as tobacco use, as well as financial factors, such as your income, when calculating your premium. Additionally, choosing between different types of life insurance products has an effect on the amount of premium being paid. In Canada, we can boil life insurance products into two basic types: term and permanent. The primary difference comes in their coverage lengths. While term life insurance covers a fixed number of years, permanent insurance offers protection for life. Both types are great for protecting and replacing your income with a death benefit. However, permanent insurance, such as whole life insurance, can help with wealth preservation through accumulating a cash surrender value. To keep things simple for today, the cash surrender value is a feature specific to permanent insurance policies that can allow the policy owner to withdraw or borrow money against their policy. So the big question, do you need life insurance? And if so, how much? One of the major misconceptions with life insurance is that you buy it for yourself, but in truth you buy it for the people you love. But do they need it? The answer to this question is that it depends on your personal situation. Do you have any debts that need to be paid off? Does someone in your life depend on your income? Do you want to leave a financial legacy? Questions like these can help you decide if you should get coverage. How much insurance do you need largely depends on a similar set of questions. While it's impossible to pinpoint the coverage you need to the penny, there are techniques to give you a good estimate. A good start is to add up your long-term financial obligations, then subtract your current assets from that figure. The remaining sum is what insurance should fill. Another option is to multiply your annual income by the number of years left until you plan to retire. Some experts recommend you should aim for 7 to 10 times your annual income. In other cases, it just simply comes down to covering the amount of an outstanding loan or debt. There are many ways to come up with a good estimate, and the answer really depends on you. Well, so you've decided that you need coverage. There may seem like a million different paths you can take, but which one is right for you? Well, let's take a further look at term insurance. When deciding what length of term to choose, you may think a longer term is better. However, this is not always true. A longer term may lead you to pay for coverage you won't actually need. Term insurance is really meant to cover a specified timeline. For example, the amortization period of a mortgage. Making sure you're covered for only this length of time helps to cut out on unnecessary expenses. Term insurance also offers a larger coverage amount at a lower premium when compared to permanent insurance. Going back to the example of covering a mortgage, you might be looking for upwards of maybe $500,000 in coverage. So term insurance is going to fit that bill. So what about permanent life insurance? The lifelong coverage and cash value perks may seem really tempting, but permanent insurance just does not come cheap. As I mentioned before, permanent coverage is more expensive than term. This is because insurance companies know that as long as you continue to pay your premiums on time, they'll eventually have to pay out the claim. On average, permanent insurance is usually anywhere from 5 to 15 times more expensive than term. However, permanent life insurance also presents a number of other benefits as well. Whole life insurance can be a great option if you're looking for coverage that won't change in price later on and will offer coverage for the remainder of your lifetime. For example, no one knows the day that they'll pass, so when looking at funeral and final expense coverage, whole life insurance can also fit that bill. The cash surrender value of a permanent insurance product can also be appealing for someone looking at an alternative way to maybe fund their retirement. For example, in whole life policies, as premiums are paid into the policy, a portion of that is invested by the insurance company. The funds compound on a tax-deferred basis, and later on in life, a policy owner may access these funds by borrowing from the cash surrender value. Finally, you might be wondering how life insurance is paid out. After the death of the insured, a claim must be made by the beneficiaries. The insurance company may take anywhere from 2 weeks to 2 months to pay the death benefit, depending on the complexity of the case. In most cases, the death benefit is received as a non-taxable lump sum or may also be received as an annuity payment or smaller payments made over time. Life insurance can be expensive, and it's important that you choose the best option for you. Additionally, doing things like quitting smoking, maintaining a healthy weight, and steering clear of dangerous hobbies can help lower your premium. On top of this, remember to focus on the coverage that you need and don't wait until the last minute to do it. So, is life insurance worth it? Well, if you have dependents or large liabilities, absolutely. From mortgages to monthly grocery hauls to childcare costs, life comes with many expenses. You do everything possible to take good care of your family here and now, but if the unthinkable happens, your loved ones would be extremely grateful for the financial safety net that life insurance offers. Life insurance is really about the peace of mind and that you've done all you can to help your family.